Bitcoin treasuries are in serious trouble. You won't see it in the chart, and you won't hear it in the headlines. But something important just gave way, and you should know. The balance sheet that's been holding this cycle together is starting to crack. And once you know where to look, the signs are everywhere. And that's what's breaking reaches far beyond price. It touches the companies, the regulators, and the institutions that pulled Bitcoin into the core of global finance. When that machine starts to strain, every part of the market, every holder, miner, and investor, feels it. So today I want to show you how that strain began to surface, where the pressure is building, and why what's happening right now could quietly reshape the setup for 2026, which if you know me, you know how I feel about it. So let's begin with the first sign that this foundation was never as strong as it looked. So let's get into it. The first cracks appeared in the place most people assumed was rock solid, that is, corporate balance sheets. 65% of public companies holding Bitcoin are now sitting on losses. What started as a few red quarters turned into board-level questions about how much pain they were actually willing to take. And the disclosures tell the story. For every 100 companies that revealed their cost basis, nearly 2/3 bought above today's price. That means a clear majority of CFOs are now watching their treasury strategy underwater. And there's no panic yet, but the filings are changing. Softer language, smaller buys, careful references to rebalancing. And behind the scenes, market leadership has narrowed to a dangerous extreme. Strategy alone accounted for roughly 75% of all corporate Bitcoin added in November. One company carried the entire public market bid for a month. That's not diversification. That's a single pillar holding up a narrative. Miners, once background players, have become systematic important holders. They control around 12% of all Bitcoin sitting on public company balance sheets. Their cost basis is lower, but even they're feeling pressure. Electricity costs are rising, difficulty is climbing, revenues are thinning. Some are already trimming reserves simply to stay liquid. And they're not alone. Sequence quietly sold a third of its stack in November. Tiny in dollar terms, huge in what it signals. That is, long-term conviction has limits when share prices weaken and credit lines shrink. Then came the MSCI shock. The index provider floated a rule that would exclude companies whose assets are more than 50% digital. JP Morgan warned the change could force up to $2.8 billion in outflows from strategy alone. Saylor shot back with a 12-page letter arguing the proposal would weaken U.S. national security and punish innovation. He tied corporate Bitcoin ownership directly to America's economic competitiveness and to the Trump administration's emerging pro-crypto industrial strategy. That's how a simple balance sheet issue became a geopolitical one. These are the first fractures, and they're forcing regulators, banks, and investors to ask how much stress this new financial structure can take before something gives. But all right, let's zoom out, as I like to do, because what's happening inside these treasuries is connected to a much larger battle over who controls the structure of the entire market. A lot of people saw the Fed cut rates by 25 basis points and thought the story stopped there. The real story began actually after the vote, a 9-3 split. The first meeting in 6 years with 3 dissents signaled something unmistakable. The consensus inside the Fed broke. And in the background, President Trump began interviewing replacements for Powell, Warsh, Hassett, Waller, Bowman, and BlackRock's Rick Ryder are all under consideration. Reports suggest Hassett is the frontrunner, though. And the moment those interviews started, Powell became a lame duck chair. A new Fed chair can rewrite the entire playbook in weeks, and markets have not priced that risk. Then came the move that revealed where the real stress sits. The Treasury market began buckling hard enough that the Fed stepped in and restarted T-bill purchases at $40 billion a month. Powell called it a balance sheet management, but traders called it something else: Soft QE, or quantitative easing, a quiet admission that the private market can't absorb the government's debt issuance alone. This is no longer theoretical either. The Fed is stabilizing a strained credit system while a leadership transition is already in motion. Institutions are operating inside an environment that is being rewritten in real time. And the smartest capital in the market noticed immediately. When the structure wobbles, smart money moves fast, we know. And over the past 3 months, 73 crypto projects raised more than $10 million, and not a single one was a traditional L1 or layer 1. That era is over. Capital is no longer chasing speed or block size. It's flowing towards infrastructure, the connective tissue between crypto and the real economy. The biggest raises clustered around 5 categories: prediction markets, payments, and banking rails, real-world asset platforms, and the DeFi systems binding them together. Not hype sectors, functional ones, essential ones. And that's exactly why institutions are showing up. Retail, on the other hand, the 99%, see a different picture. The total meme coin market cap collapsed from over $100 billion to around $39 billion by late November. The majors fell more than 90%. Search interest hit cycle lows. But user behavior tells a different story. Pump.fun is still near the top of global volume charts, clearing over $500 million in weekly trades and setting a one-day record above $1 billion in December, just recently. Fees averaged $2.7 million per day. The culture quieted, the product didn't. Smart money pays attention to that. And that is because they're watching a simple pattern. Hype is fading, but usage is rising. Retail sees decline. However, long timeline investors see survival and selection. Bitwise CEO Hunter Horsley put it bluntly. We'll look back on 2025, he said, and realize it's been a bear market since February, masked by DATs and Bitcoin Treasuries. Everything else is lining up for a massive 2026, and I couldn't agree more. When capital rotates this sharply, it's not retreating, it's repositioning, and some sectors are already showing why. Here are the 3 sectors now operating with the strongest tailwinds. Prediction markets went from curiosity to regulated finance almost overnight. A trader on Polymarket turned $3,000 into $125,000 by betting on the most Googled person of the year. That caught headlines. But the real story is institutional. Washington formally recognized prediction markets. Kalshi, Coinbase, Robinhood, Crypto.com, and others created the Coalition for Prediction Markets to push federal rules. And Gemini Titan secured a CFTC license after a 5-year battle. And NASDAQ, CME, Kalshi, Polymarket, and Gemini now sit together on the CFTC's CEO Innovation Council. This is the start of a new layer of financial infrastructure, one where capital moves towards information before the new cycle does. Perpetual markets are next. Hyperliquid launched equity perps, giving DeFi access to the $86 trillion equity options market. Capturing even 0.5% of that flow adds over $400 billion a month in volume. Network revenues could run into the billions, and buybacks could turn hype into one of the highest yielding assets in crypto. Cascade is right behind them, building 24/7 perps for every asset class: stocks, FX, commodities, with fiat rails powered by Stripe's bridge. This is a trading layer that never closes, a market structure where previously disconnected worlds suddenly talk to each other. The payments rail is the third wave. Stripe expanded aggressively this quarter, acquiring Valora to accelerate its stablecoin strategy. The OCC approved banks to act as crypto brokers. The CFTC approved Bitcoin, ETH, and USDC as collateral for US derivative markets. Then came Stripe's Tempo blockchain. Tempo's public testnet launched December 9th with partners like OpenAI, Visa, MasterCard, Deutsche Bank, Shopify, Nubank, Klarna, Brex, and UBS already testing. It's Ethereum compatible with half a second block times, 1/10 cent fees, and stablecoin native gas. It's designed for throughput and compliance, not speculation. When you stack these three categories together, prediction markets, perps, and stablecoin rails, you see the outline of the next system. Each one fixes a part of the old structure that's cracking right now. And all of them are scaling quietly while most people just watch price. But all right, let's close with the part of the story the market won't understand, unfortunately, until next year. Everything we've walked through points to one conclusion. The market is changing shape in real time. Bitcoin treasuries are under pressure. Regulators are redrawing the rules. Capital is migrating towards systems built to survive this transition and replace what can't. What's being built now? Markets that trade truth, perps that never sleep, stablecoin rails embedded in global finance will define how money moves for the next decade. It's a full rebuild of the financial map. And crypto sits directly at the center, right at the heart center. For investors and builders, the game is shifting from speculation to participation. The biggest gains will come from understanding where the next layer of infrastructure is forming and positioning early, which are the types of tokens I share with you here. While everyone else is chasing the last narrative, we see the foundation of 2026 already being poured quietly and by the people building these new rails. And when the world finally catches up, you'll want to be standing on the side that saw it coming, which is us here. Everyone tuned in to my video today. I love you guys so much. Thank you for joining me today. Like the video if you gained value. Share the video with somebody who needs to understand what's going on and wants content that connects the dots for you. Take care, and I'll catch you guys here tomorrow. Ciao.